it hits you. I don't pretend to have the intimate understanding of the cash cotton market and the intricacies that you all have. In life, you've already forgotten more about that than I'm ever going to know. But what I can bring aboard your train of thought are some of the issues that are currently in play that have a daily effect on the futures, options, and OTC markets that may have so much of an influence on your decision-making processes. Not a lot of value I see in going over the data of supply and demand here. Those numbers that traditionally reflect the price directional influence on any given supply-demand balance sheet. All of you can look the numbers up. You probably have staff that does it for you. And the mere fact that all the information available in the world is now instantaneously accessible to you via the internet on a mobile phone may just be one of the most decisive differences between our world today compared to any other time over the past 100 years. This was made clear to me this past month when I put out the bid to get a new tin roof put on a barn on our family farm here. The lowest bid came back at $20,000. It stipulated 4 workers over 2 weeks using 3 scissors lifts. And I showed my 25-year-old son, who scoffed and said, "Well, let me look that up online." Okay, I was skeptical, but I said, "Go ahead, have at it." Well, after he explored a bunch of YouTube do-it-yourself videos, he told me there was be no sweat, we could do this ourselves. Well, by the time it was said and done, the roof was put on in 3 days by 2 guys using 1 scissor lift for under $5,000. Now, granted, I was one of those 2 guys, but I wasn't the boss on the job. And afterwards, it dawned on me how different the world is today compared to when I, and dare I say most of you, were coming up through the ranks in your respective careers. For many occupation, gone are the days of having to live it to learn it. I'm sure that we've all seen how these newly hired millennials show up expecting to be on equal footing with some of the tenured seasoned pros in the business. After all, they not only do they know as much as we do on any given topic because they can look it up on the net, but because they're more technologically proficient, they can do it faster and more efficiently than some of us. I think that second half of that comment is probably what the world we now live in. But all's not lost. Experience still counts for a lot. And I'm willing to say that the more chaotic things get, the more valuable your gray hairs become. In the past 7 months dealing with the COVID calamity, if it's taught us anything, it's that we will continue to face levels of chaos nobody's ever dealt with in the past. And this doesn't even address next Tuesday's election. I'm looking forward with trepidation to the results of the election. As mentioned, Tim and I were discussing earlier, probably the worst case scenario would be for either side to win by just a little, because then it throws things into the courts and more chaos. So keep in mind that the trick, I think, going forward is going to be collecting your focused knowledge, focusing your years of knowledge and experience. Instead of looking from the outside in at your business, use your experience to look from the inside out. And I think that's going to be key as we go forward. You may have heard about the recent military war game that was put on by a Top Gun fighter, ace pilot that was from I believe the Navy, and was matched up against a series of dogfights against an artificial intelligence program called GPT-3. The artificial intelligence program had 175 billion parameters to consider and was built to have the ability to think and reason like a human. Now, for the record, Google already has an AI program that takes into consideration 600 billion parameters. Microsoft, one that takes in 1 trillion. And what was meant to be conditions replicating a live dogfight, the program beat the human 5 out of 5 times. I was rooting for the human, but he lost every one. Now think about it. We were pitting a mortal human, albeit a man among men, against a computer that can recognize a target and in nanoseconds choose a weapon, figure an intersecting vector, execute the needed aeronautic actions required to get in position, implement a firing sequence. And in doing this without any adrenaline rush, stress, or having the effects of gravity. So it really wasn't a fair fight from the start. And if you think this is just a one-off for use only in militaristic applications, it's anticipated that over the next 4 years alone, global spending on artificial intelligence is going to more than double to $110 billion. Closer to our agricultural home, the pandemic has forced us into a new hands-off era of agricultural production forecasts. These rely on satellite and drone imaging along with artificial intelligence, and less on data and observation by humans. USDA crop tours, which due to COVID travel restrictions are severely restricted, now seem almost quaint. Around the world, new analytical programs are being developed to estimate crop size and condition. In a joint effort between Kumi Analytics and the Futures Commission merchant Merrick Spectron, a new tool has been developed using geospatial technology and machine learning to estimate the number of US planted acres and the projected yields. In South America, using the second SAOCOM satellite dish, cloud piercing and in some cases ground penetrating radar images are being beamed back to Earth to help analyze growing conditions, most notably groundwater and soil moisture levels. In effect, this will be estimates from space. On the island of Hawaii, Kona Hills Coffee, the recently developed largest coffee plantation in the islands, is using autonomous drones to fly daily grid patterns over the 2,500 newly planted coffee trees. They take photos using a different series of lens filters to collect a wide array of vegetative, insect, moisture, and soil element measurements. The drones take off and return to their stations around the perimeter of the plantation. And when they redock and recharge, their data is automatically downloaded via the net to the University of Hawaii's Agricultural Department for analysts. The data managers can then determine pesticide, herbicide, fertilizer, and moisture requirements on a square yard by square yard basis. Up until the time the information is analyzed, there is no human interaction involved in the process. And even when the human to machine interface is involved, big data is still being utilized. Take, for instance, the fleet management and transportation tracking company, Samsara. The San Francisco startup uses dual-facing dash cameras, GPS tracking, telematics, and more to track and trace all the movements of vehicles and the conditions they travel through in order to protect the drivers, the vehicles, and the goods they carry. In effect, the service provides what you might call a blockchain for logistics on the physical transportation of goods, where every continual geospatial location and environmental condition that the goods go through can be accounted for from seller to buyer. Applied algorithms can then be used to calculate insurance rates, product liability, and eventually systematic transportation models for autonomous driverless vehicles. So what does this have to do with the cotton market, you may ask? Well, plenty. The artificial intelligence in the form of robotic word recognition software programs now read published headlines, which have so often themselves been written by other computer programs. Then, using algorithms, computers instantaneously react by electronically entering buy and sell orders into the markets. This happens in microseconds. Today, 85% of all stocks, and some say more than 50% of all commodity market orders, are traded by computers with no human interaction. This makes it essential to understand the outside market forces and how they have a cross-current influence on your markets. In effect, the status quo has changed into the status quant. One quick example I like to use, and I'll apologize here for those that read our daily logic letter and would have heard this story, read about this story in the past. This is how social media now plays into the investment world. Historically, Wall Street firms would hire the best and brightest MBAs coming out of the Ivy Leagues in order to try and deal with the intricacies of the financial world. Starting a decade or so ago, it'll shift away from MBAs and towards mathematical engineers was seen. Facebook, LinkedIn, Twitter, Snapchat, and all the other social media companies were selling their access to their data to the Wall Street firms who were eager to see how this information could be monetized. Remember, nothing is forgotten online. When you answer one of those polls on Facebook, like, what's the name of your favorite pet? Or what was your high school mascot? Or who are you going to vote for? Well, your response leaves a digital fingerprint that doesn't go away. What the major players on Wall Street were looking to do was to mine the social media platforms, looking for patterns that had positive correlations with trends of different investment vehicles. Media mining of big data now allows for the analysis of market influencing factors at an accelerating rate never seen before. As a hypothetical example, let's say it was discovered that when an increase in the global internet clicks on the word calorie was seen, then a price jump in the stock of Weight Watchers followed, and the price of sugar futures dropped. Well, algorithmic robots or bots would detect the click increase of the word calorie, and in a nanosecond, they'd buy Weight Watchers stock and sell futures on sugar short. Eventually, after comparing literally billions of click patterns to investment trends, the increasing number of computer programs started to match each other and feed on each other to see who could get their orders in first. Eventually, one of the smarter algo traders figured out a way to beat the others. Knowing how their operations work, knowing how they predicted the cause and effect, he figured out that by going in using the same hypothetical situation and would buy Weight Watchers stock, sell sugar futures short, and then have his bots enter into the social media blogosphere, if you will, the word calorie, knowing that the computers would react as they would. So by using this artificial intelligence, he effectively reverse engineered the cause and effect of the stock and commodity markets. In order to get a feel for the size and scope of the available data to be mined, this chart here to the right shows just how much information is generated in a single minute of a single day. Because they never eat or sleep, algorithmic computer programs constantly chew through this ocean of big data to find calculated correlations and price differentiating trends. So if you think you're going to be able to use traditional supply-demand balance sheet statistics to manage your risk in the commodity markets, you're fooling yourself and feeding the algos. Again, all is not lost. When you think about it, that program reversing algo trader used human ingenuity to turn the tables on his rivals because he understood how his competitors and their computers were working. Never sell short the incredible assets of human ingenuity. It's the ever-present advantage that humans have over machines. One of the things I like to remind people on an ongoing basis is the reason they're called computers is because they take data and compute it. That's it. They don't think. Cross-current analysis between markets and the factors that affect them are still relatively virgin territory for these algos. And that may not be long as artificial intelligence takes over. So, what kind of outside market forces do you think anybody should be on the lookout for? Well, in the wake of the global financial crisis, money center banks endeavored to save the global collective economy by printing money to increase liquidity. These two charts here show just how much liquidity has been pumped into the US and the Eurosystem's respective economies. Reactionary moves to the financial battle in the COVID calamity has only served to exaggerate these issues. One of the unintended consequences for this has been a spiraling down of interest rates. Prior to the global financial crisis, the rule of 7 dictated that money invested in government paper would double in value every 7 years. With the ultra low to negative interest rate scenario that exists today, this is no longer the case. This chart to the right shows how much money needs to be invested to spin off $50,000 per year in income on a triple net basis. You can see that since 1998, when it started, you need a whole lot more money to generate passive income. This recent influx of equity requirement has resulted in rendering government paper for retirement is effectively proving that fixed income is broken. Because insurance companies, pension plans, money managers, and every retiree who lives on a fixed income derived from interest rate bearing vehicles can no longer continue to function on returns of less than 2, 3, 4%. Alternative vehicles have been required, some requiring significant leverage in order to make up the difference. Eventually, commodity markets have been discovered, and with the help of a new asset class by the name of exchange traded funds, ETFs, anyone can invest almost any conceivable market, in many cases using a fractional basis to enter the market in what looks like a stock or an equity. Today, there are more ETFs than there are stocks listed on the New York Stock Exchange and NASDAQ. As for commodities, leveraged long and leveraged short ETFs allow participants to enter a market on a 2-to-1, 3-to-1, 4-to-1, or greater leveraged basis, while using an investment vehicle that looks just like a stock and can be bought and sold in pieces, not as a whole value. Popular fractional stock ownership's phone apps now allow investors to buy pieces and shares of stocks and ETFs on commodities futures. In fact, Fidelity now offers a phone app for their customers, which recognizes what is trending in social media so that you can trade fractional shares of stocks and ETFs against the flow of data in the collective social media universe. The effect on the markets has been dramatic. The most egregious recent example was when the crude oil futures market went into a negative price during its delivery period this past April. A very popular phone app by the name of Robinhood allowed small speculators to buy crude oil futures en masse and in the form of a leveraged ETF. When delivery time rolled around for the April contract, commercial oil companies were trying to deliver against their short futures positions. But due to the COVID-caused demand destruction, there was no available storage left at any exchange-approved delivery point. As a result, prices were driven down and at their worst, hit a negative $40 per barrel in price. The leveraged long crude ETFs were absolutely crushed. Now, certainly this was a one-off and not something that we would anticipate happening anytime soon, but it is an example of how much money is being thrown at an otherwise seemingly logical investment and how quickly it can go pear-shaped. And you can use this lesson to learn from when dealing in your own markets. Speculative money flows can and always will exert far more price directional power on any given market than can be exerted by those in the industry that market represents. We experienced an example of this of our own in the cotton market back in 2008. Looking back now, in March of that year, during a span of 1 week, New York futures went from 80 cents to 91.38 on the chart, but traded synthetically well over 97 before falling back down to 79 cents. It permanently changed the makeup of the cotton industry's participants in the process. We now know that Wall Street speculators realized that the collective trade held short hedges against multiple forward crop years of multiple growths overseas. At the same time, banks were being threatened with implosion of the credit default swap industry, and the cotton merchants' commercial banking lines of credit were maxed out. The result was that the hedge funds and large institutional investors went long a maximum number of futures and options positions. Overnight, banks balked at having to cover margin calls for the trade's short hedges on crops that were 2 and 3 years away from even being planted. Forced to cover these shorts, some of the oldest and most revered cotton companies in the world subsequently closed their doors and exited the business. Counterintuitively, those who were the most fiscally conservative at the time, having bought the bales and sold the board, were the ones who lost the most. Seeing the actions of hedge funds, and in some cases, we actually handled some of the trading leading up to this debacle, we had been warning our commercial clients of the risk that they were taking on when facing off against the Wall Street money managers. It was at this time that, in an attempt to draw attention to that danger, that I coined the phrase, the specs have more money than the trade has cotton. And that applies to all markets, and that's the truth. Keep in perspective that the amount of money in the commodity markets globally is dwarfed by the amount of money in the stock markets, which is dwarfed by the amount of money in the interest rate bearing vehicles, which is dwarfed by the amount of money involved in foreign currency trading. Keeping track of these money flows will allow you to navigate through the unseen undercurrents that can take you onto the rocks, even if your fundamental balance sheet projections project smooth sailing. I'm here to tell you that you all have an advantage, just like that algo trader I mentioned earlier, who knew what his competitors' computers were trying to do. You, in your trade and the commercial side of things, can learn and react to what the speculators are looking at. At the same time, the speculators cannot comprehend whatsoever what you, who are in the trade, have intimate knowledge of. In effect, you get a peek at their playbook while they have no clue what's really going on inside your game plan. That's the advantage that you have and always will over the money managers. As computers that utilize social media and other quantitative analysis continues to take the upper hand, speculative perceptions are going to increasingly take over fundamental facts as we look for drivers for futures markets pricing. It's these types of shifts in volatility and price swings that make the use of options and over-the-counter solutions instead of one-on-one futures hedging more of a necessity today than before. Those who continue to hedge one-on-one with futures as opposed to managing risk using a variety of tools available today may be taking on more risk than they are putting off in the futures market. This will become increasingly important as money flows take over from actual balance sheet fundamentals in driving market prices. In addition, in this election year, volatility is on the rise as headlines and presidential tweets continue to pump up the importance of perception of values over reality. As volatility increases, so does the danger of being locked into a long or short futures contract. And given the amount of speculative money looking for a home, the net effect will be amplified. Already starting some 2 to 3 weeks ago, the commodity exchanges started to increase the margin requirements that you needed to post in order to hold an open position in anticipation of the increased volatility expected in the wake of next week's elections. So they've already understood that there's going to be more chaos, more volatility, and they're asking you to post more money in order to participate in the markets. Looking ahead, some will argue that the balance sheet fundamentals will become nothing more than cocktail talk fodder. Traders may eventually convert to using cross-section of instantaneously determined statistical algorithms in order to determine buy and sell signals. This disconnect between perception and reality can serve to disrupt the natural correlation between your cash and your futures markets positions. Overall, I agree fundamentals will continue to direct the macro condition, but the effects of the massive amount of money now available to be invested, along with the quantitative traders' tactics, will increasingly have a greater temporary sway on the market's direction. And even if the effect is only for a day, a week, or a month, margin calls must be met, and cash markets will be forced to react. This will, in effect, put the commodity horse before the commodity cart. So, where do you turn for guidance? Well, here comes the commercial. Here at RCM Alternatives, in addition to providing solid fundamental understanding of the marketplace, we offer daily data flows and analysis to keep our clients informed of the macro events in the outside marketplace. In effect, keeping you aware of those things that can sneak up from behind you and hit you when you're not looking. We provide vertical market risk management solutions individually tailored to the needs of the producer, the processor, and the end user, both by using traditional hedging tools as well as through the application of the increasingly popular over-the-counter products and developing risk management schemes. Again, I would like to thank the ICA for inviting me to speak today, and I will now attempt to answer any and all questions. I understand you guys can enter them or have entered them with Tim, and he'll go ahead and proceed. So I'll turn this back to Tim and shoot with the first question.
Well, thank you very much, Ron. And I have to say to the audience that not only did Ron give a very interesting and enlightening talk there, but it is also 5 o'clock in the morning in California from where he's speaking. So an extra special effort from Ron. So thank you very much for that. Indeed, the world has changed tremendously since 2008, which seems almost like 100 years ago, when real live human beings were operating in the trader's pit. But it's a very interesting perspective, the world in which we live in today, Ron, that you've shown us. So we've got some questions, and these come from the floor. And again, I would encourage all of you on the Q&A feature to put forth questions so Ron can answer them. So if the US election, and this comes from an anonymous attendee, if the US election is a close win for either side, what impact could this have, Ron?
It's long been my opinion, and I've written about it extensively, that the greatest danger to any market is uncertainty. Simply put, if you have to solve for X, you get a bad bit of news. We know how to react, we know how to analyze and take moves. When you have uncertainty, you have to first try to figure out what the problem is. And the more problems they come out of an uncertain election requires that much more energy to figure out the different options that you have to take. So if we go into a contested election result and it goes into the courts, it's going to enter into a period of uncertainty as to whether we're going to have a change in the government's opinion of oversight, a change in the government's efforts for tax relief, a change on how we deal with China. All these unknowns are things that the markets just, the old line in the trading pits was, when in doubt, palms out. So you would sell. When you didn't know what was going on, you just sell. So uncertainty typically drives markets lower. So if we have a close election result that ends up in the courts, the uncertainty is going to initially put some downward pressure on all markets, and it's going to go across all markets. It's going to be stocks, bonds, commodities here in the US as well as overseas.
Thank you, Ron. Another question, also from an anonymous attendee. If we rely so much upon computer programs, what is the risk that one of these programs bugs out? And what could that lead to?
It's part of the reason why the American Cotton Shippers Association has pushed with the CFTC to keep the limits on the positions that we would like to maintain. If you have no limits on what a position can be established, and you have one of these computers go haywire, certainly that adds to the risk. I would suggest that, given how much you guys know about the intricacies of a futures commission merchant, but even today, day traders can have a maximum position they're allowed to carry overnight, but during the day, intra-market, they can have a multiple 200-300 times that position on. Should they not get out of that market before the close, they have to post the margin. There's been situations in the past where, one of the most notable was in a wheat market, a Kansas City wheat market situation, where a trader went on vacation while being short during delivery. And on the last trading day, the market moved up $15 a bushel, not cents, dollars, as they covered the last 100 lots unbeknownst to him while he was in the Caribbean. So yeah, humans can go haywire, computers can go haywire. Again, it's why I believe keeping a limit on the maximum number of positions for speculators is essential.
Okay, thank you, Ron. Ron, before we move to the next question, I don't know whether you've got access to the export sales report, but it should have just come out if my clock is right.
Yep.
Any thoughts?
So for Upland, net sales 288,700 for this year, 900 bales for next marketing year. Pima 32,700. So not a bad number. China 93.9, Pakistan 126.6. And we know the Pakistani crops got issues again due to poor seed, and China coming into the market. So it's pretty good numbers on a net basis. There were cancellations of 108,000. Turkey 53.9. Understandable given the Turkish lira's depreciation recently. They don't have the funds that you would think. Bangladesh 26.3. So 108,000 was canceled, but we still had net 288.7. Shipment numbers 228,800 with 15,900 in Pima. So 240 or so. We still need to get the shipments up with the dislocation. Certainly on the West Coast, we're starting to see more goods shipped out of the Gulf. Long Beach, LA harbors, it's a real cluster down there. Shortage of chassis, imbalance of containers. Hapag-Lloyd recently said they're not going to ship any agricultural products off the West Coast, claiming that they need to have a more efficient manner to get empty containers to the Far East. Some would say they're simply walking away from the low margin agricultural shipments and going preferentially to the higher margin products. So either way, it's going to put a dent in our ability to ship ag products to the East. So good export report today. The market does not seem to have reacted much in either direction. So.
From Jerry Marshall, are you saying we are the fish at the algo's poker table?
Well, yeah, I would say yes, but we can read their tells. Again, you have to remember that these money managers who will be investing in a wide menu of investment opportunities, some of which are commodities, one of which is cotton. They do not have the wherewithal to become experts on any given single commodity like cotton. All the people here watching are. So what they're going to do is apply a generic set of rules to their investments, whether it's looking at a weekly continuation chart, a moving average. They're going to apply rules that apply to all of their markets so that they can get on with it. On the other hand, when we are mono commodity managers here, we understand the intimacies of the cotton market, but we also know what they're looking at. We know they're looking at moving averages. We know they're looking at the weekly continuation charts. We speak with these guys because we handle their trades, and we understand where they're coming from. So again, you get to look at their playbook. They have no idea of your game plan. And you do have that advantage in that they don't know what you do, but you understand the way they're coming at it. And that's a huge advantage, and you should not ignore it. Thank you, Larry.
Here's an interesting question. The previous high of net positioning is 108,000 contracts. Given the increased liquidity, what do you think the new maximum could be?
How high is up? I think you're going to, one of the things that you have to remember is that if you have on a swap or an OTC position, it's not necessarily registered in offset on the futures market. So I would argue today that there are already positions well above what we see on the futures market in the OTC markets. The risk is that an OTC market maker has a customer that does not perform on a very large position. Well, there are no trading limits on an OTC basis. There are in the futures markets. seeing the amount of participation in our market double, that's certainly a possibility. Wouldn't write that off at all. You got to remember how much money is out there right now sitting on the sidelines looking for a home, trying to find some type of return. Dollar for dollar, you can't compare equities to commodity futures. If you have $100,000 on margin, you can buy $200,000 worth of stock. But $100,000, when it comes to margin money for a futures position, you can buy millions of dollars in commodities. So it doesn't take a lot of money to control an immense amount of any given commodity. I've talked to money managers and trading guys, and one buddy of mine over in London on a trading desk, he trades the index futures for his customers, and his loaf of bread is 6-pack of beer, his gallon of milk, his round lot is $100 million. So one order for him is $100 million of the commodity index, and he trades thousands of these a day. And he's one guy on one desk, a small ice cube in the tip of an iceberg. So there's so much money out there that can be applied to it. You almost, it's the idea, you want to ride the bus, you don't want to get ahead of it. And certainly don't be chasing it.
Okay, here's an interesting question. This is from Daniel Santa Ana. We are seeing now a major commotion disruption with carriers shifting equipment to China as the import rates are almost 8 times higher than export rates from the US. So this might impact drastically trading as an unseen factor, the ones that hurt you the most. What do you think of that? I mean, here's a fundamental consideration. I wonder whether the algos pick that up.
I think the algos will eventually, as the data flow comes back. Remember, a lot of the numbers we look at are look back numbers, as opposed to forward pricing. I think what everyone has to realize is that China needs our calories. Plain and simple, they can't produce enough food to feed themselves. The government that exists today came into power during the food famines of the 50s and 60s. There's no way they're going to let their people go hungry. So they're going to continue to import agricultural goods. The knock on is in cotton, you're likely to see a greater increase in non-food imports as they attempt to grow food instead of fiber. We've all seen the pushback on Xinjiang fiber because of human rights problems in Xinjiang. And I think that that's going to have a major effect on what China does with the ground. Do they switch it over to wheat? Do they maintain their domestic textile industry simply with Xinjiang, and the rest of the country goes to produce food, not fiber? They will continue to import what they need. I would say maybe they're going to produce what they need and import what they want. And I think that sounds like a small difference, but they're going to need to continue to import things just to keep status quo.
Okay, interesting. Look, I'm going to give Jerry Marshall a second bite of the cherry here, because I really would like to know your answer to this question. It's a good question. With the use of OTC products being so prevalent, how effective are exchange spec position limits?
Well, you got to have rules somewhere. I think you can't just light it on fire and let her go. So remember, what an OTC market maker does is he takes a long position and a short position for 2 separate clients. So the net effect to them is 0, for instance. For a futures commission merchant, the way they used to charge for gross and then pay net to the exchange. So if I have 100 long from one customer and 100 short from the other customer, you get the commissions for both, or you get rather the margin money from both, but you post 0 to the exchange because you have the same number of longs as you do shorts. Well, that's how an OTC market maker works. So their net position is the important part, not the gross. Do they have more, then they take, at the end of the day, they look at their overall net long or short, they offset it on the futures market, so they go home even at the end of the day. You could get, theoretically, a major player come into the game and offset the balance on the OTC side. It's a self-regulating thing. It's up to the OTC market maker to make sure that they're not in that overburdened position. And their margin lines are going to require it. They're going to have their own internal marketing rules. They got their own internal margin rules. So yes, it's possible. But I think with the oversight that's in there internally, I think it's unlikely.
Okay, here's an interesting question from Mike Edwards of Kotlook. Can algos predict basis volatility?
I'd say yes, in the fact that they can look at factors, multiple factors. For instance, when we looked at the fighter jet example, if they can look at 1 trillion parameters, out of that, mining that data, things like weather conditions, temperature, rainfall, currency, shipping, insurance. I've always held cotton as a commodity is the best and longest leading economic indicator there is. And it's simply because from seed to sweater, cotton is put through more processing, changes through more hands, is exposed to greater amounts of influence than any other commodity. So as you pass through that, it's a natural barometer of what the global marketplace. I've often said if we were heading for Armageddon, cotton would already be there. So as far as basis is concerned, if that is a product of the collective influence of many things, if the algos get it right and they do reflect all those things that we all innately add up, subtract, multiply, and divide, eventually they'll be able to predict that. I would say yes at some point.
So the answer is yes. Yeah. Okay. Bearing in mind we have an international audience here. It is, after all, the International Cotton Association. An anonymous attendee asked the following question. In your humble opinion, how do you consider US actual agricultural policy, particularly in the cotton industry?
I believe that you're going to get, depending on the next 4 or 8 years, administration-wise, you're going to get additional support from the administration, whether that comes in the form of price support mechanisms, handout give outs, as we seem to try and protect, to compensate for the losses from COVID. The United States has this reputation in the world, I believe, we can feed the world. We have that capacity. And I think that will continue. It's one of our strong assets. Unlike many other countries, we can feed ourselves and then some. So that's always at a basis. And I don't think that that's going to change. What could change are our reactionary moves, specifically to China, but to other countries as well, as the demands increase and decrease, both geopolitically and actual supply demand. An example, we've seen through the One Belt and Road program, China's gone throughout the world and financed tremendous amounts of infrastructure in countries that may not be able to pay back the loans given to build the infrastructure. China will then take them over. In Brazil, they've exported so many soybeans and so much corn to China that they now have to import. And they're looking to buy soybeans, Brazil is, from the US. They've removed the tariffs on importation of corn and soybeans. And so things do run ahead of itself. So for US policy, I believe it will be reactionary to the needs of the world and not so much anticipatory for the needs of the US farmer. And as far as how we operate in that space between buyer and seller, I've always held that you show the rules of the game to a cotton merchant and he'll beat you at those games.
Thank you, Ron. Ron, on the eve of the US election, which has such an influence on so many aspects of our lives around the world, the trade negotiations have had and continue to have a major impact on our cotton market. A change in administration, should Biden win, how do you perceive that will affect the trade negotiations and more specifically those really with China?
On the surface, I would suggest that there's a milder approach that would be taken as opposed to an aggressive approach under the current administration. Milder may be good, it may be bad as far as cotton is concerned. I believe they'll try to reach out some type of olive branch to an attempt to make amends with the Chinese government in an effect to reduce the friction. Will that turn into greater sales of cotton? It should, but we do know that China's trying to rebuild their strategic reserve. They need to buy cotton, and regardless of who's in the White House. So I'm looking forward to increased demand from China for cotton, and amongst other things. And then it'll come down to maybe perhaps fiscal policy. What's the dollar going to be worth under a Biden administration? What's the dollar going to be worth under a Trump administration? What will the Fed be able to do as opposed to legislatively change the economic direction of the country? The Fed's pretty much thrown everything it can at this economy. They've lowered rates. They say they're going to keep them down. You're likely to get inflation because you've got too much money trying to go after too few goods. So I see a weaker dollar going forward in any case, which is going to make our commodities more attractive to the rest of the world. And if you look at the way the yuan's trading, it's on fire. It's really moving hard to the upside. So I would say that on the initial blush reaction, the markets are likely to see a Biden election as more inflationary, pumping more money into the system, a weaker dollar that would benefit cotton prices. And a Trump win, we'd be running under the same motor that we're running now, which is still a gradually appreciating demand-driven market. It's not a supply scare where it spiked and comes back down. We're stair-stepping up, and that could go longer and last longer than most people think.
Okay, interesting. I've got time for just another couple of questions. We're almost at the hour. There is increasing pressure for social media companies to be governed by external forces. Do you think this will ever happen, and what impact would this have on the markets?
Yes, I do, and I'll go back. I don't know the age of the most people here in our audience, but when the government stepped in and broke up AT&T into the baby bells, it arguably it took a great company and made it into a whole bunch of different great companies. But then, one of the big driving factors was, in addition to breaking up a monopoly as they perceived it, it was to gain greater control over the individual companies. If the social media companies don't come around, if you will, and create their own self-regulating organization. Look at our futures market. We have the Commodity Futures Trading Commission. We have the National Futures Association. If they don't come around and do something like that, certainly if you're going to get an increase in overall regulations, certainly they're going to feel that pressure too, and you will either get a self-regulated industry or you're going to get a government industry that's going to be regulated by the government, so regulated. So the effect on the markets, the only thing that travels faster than light is money. And I think we'll see the indication of what's going to happen in the price of their stock before we see any declaration by the government.
Okay, thanks, Ron. Here's another logistical question. And these algo projections, is international logistic freight levels, deployment capacity, are these analyzed? And what influence might they have over our cotton market, for example?
Well, I think you've already started to see the Baltic Freight Index. You look at things like that, indications that can be monitored and tracked and charted, and looking at where the money flow is. So if, again, on a macro sense, as U.S. dollar weakness continues, and then U.S. goods become increasingly attractive to overseas, that's going to push a net export business. Right now, today, at the end of this month, amidst the COVID rebound, it's very difficult to get a normal idea of what's going to happen. One of the things that I've tried to explain to people is we saw back in April, the cotton market hit a major low bottom. And in my opinion, the computer algos, not just in cotton, right across the board, they factored in the worst case scenario possible for the coronavirus and they sold every stock market down. They sold all the commodity markets. Cotton hit a bottom. Now, we went back and looked into the 1940s and saw that on the weekly continuation chart, whenever you have a major bottom, it's followed by 2 consecutive weeks of higher lows, and then it's, off to the races. And we've been pointing that out since then. I believe that the market got so oversold, immediately factored in all the horrible things that were going to go on. And from that point forward, we've only seen improved consumption. And unfortunately, due to weather, we've only seen a smaller crop. So the fundamentals are exerting themselves. And I think that the computers are picking this up and taking it into account. And I think you'll see that in freight rates. You're going to certainly see factoring in energy cost. And you're going to look at the supply demand of onboard space that will also come into play for that.
Okay, thanks. Almost on the hour here, but interesting question from Nick Earlham. The blue wave, long everything, short US dollar is very overcrowded at the moment. And these passive investments, well, they don't have a brain. Do you see any situation happening with a contested election that this passive investment is withdrawn at a similar rate to that which it came in over the last few months?
I think we're going to get whatever we get is going to be the old line that first rallies never hold. We're going to get a fitness start. I think there's going to be a blush reaction to a contested, and then we look at what could maybe happen depending on who is ultimately found to be the winner. Again, the uncertainty is kryptonite to the markets. So you can make a case that whatever trend existed before the uncertainty will reverse, but it would likely be only a temporary reversal, and then you revert to the mean at that point. I've heard people say, "Look, just buy calls and puts," and then you got a foot in each grave, right? But it's a limited risk situation when you own the puts and you own the calls, and then you see which way it goes.
This is really has to be the last question, but I think it's quite prescient considering the theme of your talk. It comes from an anonymous attendee. It seems that algos makes the fundamentalist obsolete. What do you say to that, Rob?
Again, I disagree. Remember, the algos are computing the data that the fundamental analyst puts out. Okay. Once again, what the algos are going to do to the data, but the data before the algos do. So my opinion is having the basic understanding of the supply and the demand gives you an advantage, not a disadvantage. You have an advantage. You know how they will react. You can position yourself with your information, knowing how they're going to react ahead of the time. So that's my opinion. Well,
Ron, we're right up here on the hour. So this has been I hope our audience have enjoyed this as much as I have. But you've done yourself and the ICA proud. And again, as far as I'm concerned, you got up in the middle of the night to do it, early hours in California. But Ron Lawson, thank you very much. Excellent delivery, very interesting speech. Looking at a lot of the comments coming in here, I'm not the only one who feels that way. So on behalf of the ICA, thank you very much.
All right. Thanks, Tim. Thanks, guys. Okay. Have a good one.
Thanks, everyone.